So Jim, how do you position for a key event risk like G20 and a lot of hopes about a Federal Reserve next move? Can you be bullish?
Well, you take a balanced approach. You remain risk aware. None of the issues that the Fed is concerned of, what they refer to as cross currents, have diminished. Some have increased. We're absolutely aware of the importance of the G20 meeting. We know that earnings are coming down the pike. We know that Iran hovers over this market ever more closely in terms of tensions there. We also know now, July 17th, Mueller investigation testimony will probably reignite some uncertainty, some volatility. But all of that is very near term and uncertain in terms of the outcome. So we take a risk-aware approach. We're very balanced in terms of capitalization. We're balanced in terms of region. We're balanced in terms of asset classes. Even in our growth-oriented portfolios, we have buffers in place as we continue to expect uncertainty and momentum to really trump, at least in the short term, market fundamentals.
So what does that mean in practical terms as far as the sectors and the kind of stocks you like?
It means to pay close attention to your overall portfolio, your long-term investments, so those which would be in the technology side of the ledger, for example, as long as they're in the hands of a good manager who knows how to be selective in that group, you're probably in reasonably good shape, so long as you offset them with, say, one of the overlooked, underloved, underappreciated sectors so far this year, the healthcare sector, where we're getting not just reasonable growth, reasonable returns, but we're getting them at reasonably good valuations on good dips. We also think that the international market has some opportunities, in particular the small, the mid-cap space in both the established foreign and the emerging markets. Those are companies who sell their goods and services right out their back door to their locale, to their region, less troubled by currency concerns and also by things like trade wars the way U.S. multinationals are.
Jim, who do you advise? Advisors Investments. Who are you actually advising?
So we advise individual investors across the nation, some even overseas, who have done a great job of building their assets, their savings, and they turn to us as a fee-only independent advisor for that fiduciary standard of putting their interests first. Chief among those interests tends to be safeguarding the assets that they've spent a lifetime building.
Right. And, you know, it's funny, I ask that because safeguarding those assets, I mean, what do you tell people who are looking at a 2% 10-year, who have saved, who have done right in terms of at least their financial future, and now are trying to live off of or deal with? Did we lose Jim?
I think we lost him.
Well, I was just getting started,
that was a good question,
Thank you, I know. There he is. Jim, you're back. All right, I was just going on and on. But you know the point of the question, which is, what do you do when you are relying on a fixed income at this point, or at least trying to save and dealing with incredibly low interest rates?
Even there, diversification matters, David, as you know. So not just building ladders of U.S. Treasury bonds, which are not yielding all that much, although relative to sovereign debt, they certainly look like a windfall. And looking at emerging market debt, looking at other areas of the market that deliver dividends, whether it's dividend-growing stocks or REITs that are nested inside of some of the managers' portfolios that we invest in. But it is a difficult landscape if you are only interested in safeguarding your assets and not taking any risks. It definitely has been a long, slow grind in terms of low yields persisting for longer than even we thought they would.
So are you positioning your clients for economic weakness or potential recession?
Well, we don't know whether we're going to get a recession or not, but we pay a lot of attention to earnings. We pay certainly attention to the economic data and to interest rates. I say one of the things that we're a little bit concerned about is the toll that tariffs may take on the emotional spending habits of the U.S. consumer, but we think it's awfully hard to keep the driver, not just of our economy, but in effect also the global economy, away from spending if they're fully employed and still reasonably confident. So we're watching the jobs data, we're watching the income data, and we're also watching the Fed, which we think is doing a phenomenal job in terms of walking this tightrope of event-driven news, which is very unsettling, versus fundamentals, which continue to point to slow growth, not no growth, at least here at home.